If you're new to investing, everyone tells you what to buy. Stocks, ETFs, crypto, real estate. Almost nobody talks about how it actually feels to invest for years. This video is not about stock tips. It's about the things I wish someone had told me before I started. Because investing isn't a math problem, it's a psychological one. The biggest advantage you can have as an investor is not knowledge, it's time. If you start early, you can make mistakes and still win. If you start late, you need everything to go perfectly. Let me put this into perspective. Someone who invests a small amount for 30 years often ends up with more money than someone who invests a large amount for 10. Why? Because compound interest needs time to breathe. And the sad part is this: most people don't fail at investing, they just never really start. Here's something no beginner expects. The hardest part of investing is doing nothing. When markets crash, your brain goes into survival mode. It tells you, sell now, wait until things feel safe. This time is different. And to be fair, there is no guarantee that markets will always recover. But investing has never been about certainty. It's about probabilities. Statistically, the rational assumption has always been that global markets recover over the long term. Let me give you an example. After the dot-com crash in the early 2000s, the MSCI World lost roughly half of its value. Many people thought the stock market was finished. But over the following years, it didn't just recover. It went on to reach completely new highs. The same thing happened after the financial crisis in 2008, and again after the COVID crash in 2020. Every time felt different, every time felt scary, and every time long-term investors were rewarded. Markets don't reward comfort, they reward patience. The investors who win are not the ones who are smarter, but the ones who stay invested when it feels uncomfortable. Most beginners wait for the perfect moment to invest. The problem is, that moment only exists in hindsight. Now imagine this. You started investing right before the dot-com bubble burst. Worst timing possible. Your first investments went down immediately. Everything you bought lost value. Most people would stop right there. But instead, you kept investing every month. While prices were falling, your money bought more shares. Month after month, your average entry price moved lower. So when markets eventually recovered, you didn't need prices to reach the old highs to break even. That's the power of consistency. Monthly investing removes emotion from the process. You invest in good times. You invest in bad times. Sometimes you buy expensive. Sometimes you buy cheap. Over time, it averages out. Consistency doesn't eliminate risk, but it dramatically reduces the damage of bad timing. Consistency beats prediction every single time. People love talking about returns. 5%, 7%, 10%. But especially in the early years, your savings rate matters far more. You can't control the market, but you can control how much you invest. And your savings rate is not fixed. For me, that realization was a turning point. I stopped waiting for my salary alone to be enough to invest. Instead, I looked for ways to create extra money that could go directly into investments, side jobs, occasional freelance work, selling things I no longer needed online, not to upgrade my lifestyle, but to increase my investments. The rule was simple. Extra income goes straight into the portfolio. As your income grows, as your lifestyle stabilizes, as you make better decisions, you can slowly increase your savings rate. That's where real momentum comes from, not from chasing higher returns, but from consistently investing more. If investing feels boring, you're doing it right. Excitement usually means risk, and risk feels fun, until it doesn't. The goal is not to constantly trade. The goal is to build a system, a system that keeps working even when you're emotional, busy, or distracted. If investing feels boring, you're doing it right. Excitement usually means risk, and risk feels fun. Until it doesn't. The goal is not to constantly trade. The goal is to build a system that keeps working even when you're emotional, busy, or distracted. And to be honest, especially in the beginning, boredom doesn't come naturally. In your first year, it's completely normal to check your portfolio way more often than necessary. I know I did. I probably checked mine multiple times a day, even though nothing useful ever changed, not because it helped, but because everything was new. Over time, that urge fades. You realize that daily movements don't matter. Weekly movements don't matter. What matters is staying invested and letting the system do its job. Wealth is built quietly, over years, not in viral moments. If there's one thing I want you to remember, it's this. You don't need to be perfect. You need to be consistent. You don't need to predict the market. You need to stay invested. And you don't need to get rich fast. You need to give your money time to work. One last thought. When I started investing, I tried to convince people around me to start as well. Colleagues, friends. Most of them had a reason why it wasn't the right time. Not enough money. Too risky. I'll start later. And the truth is, many of them earned the same as me. Some even more. Years passed. Today, some of those same people tell me they wish they had started back then. Not because I was smarter, not because I earned more, but because I started while they were still waiting for the perfect moment. Don't be the person with the best excuses. Be the person who simply starts. If you do that, future you will be very glad you did.